Why did mortgage rates go up after the Federal Reserve cut rates? The Federal Reserve cut interest rates by 0.25% on September 17th. Many people expected mortgage rates to drop too, but instead they went up. Why? The Fed controls short-term rates in the US, specifically the overnight lending rate between banks. This is the baseline for other forms of short-term lending, so the Fed has a lot of influence over short-term interest rates. But mortgage rates are tied to long-term bonds, especially the 10-year Treasury. A Treasury is a bond issued by the Federal Reserve. Long-term bond yields are driven less by the Fed and more by expectations of economic growth and inflation. When the Fed cuts rates, sometimes investors see it as a sign of weakness in the economy. That can push long-term rates down. But other times investors think the Fed is prioritizing growth ahead of its 2% inflation target. In that case, they expect higher inflation in the future. Bond investors don't want inflation to outpace their returns. To protect themselves, they demand higher yields. Those higher yields lead directly to higher mortgage rates. So even when the Fed lowers rates, mortgage rates can rise if it causes investors to worry about inflation in the future. The opposite can also happen if central banks raise rates or leave them too high for too long. It can lead investors to believe that the high rates will stifle growth, putting downward pressure on long-term bond yields. It all comes down to how the bond market views the future of growth and inflation. To learn more about the mortgage market and bond investing, visit our blog at 49thparallelwealthmanagement.com or pick up a copy of my new book, Crossing the 49th Parallel, a retirement planning guide for moving across the Canada-US border. From the desert to the tundra, we are your cross-border retirement experts.